I've been doing mortgages a long time. I've been doing mortgages over 10 years now. And for whatever reason, people still get this one thing just so wrong. The feds are cutting rates. They're doing it. The feds are cutting the rates. The f does that even mean? No one really knows. Everyone gets all excited, and the news is the worst at this. They automatically tell you, hey, good news. The feds are cutting rates, so mortgage rates are coming down. No, it's not at all how it works. Here's what actually has been happening. On September 18th of 2024, the feds cut their rate by 50 basis points. Here we are with this technical term again, 50 basis points. 0.5% is what 50 basis points is. But in that time frame, we have seen mortgage rates do nothing but increase. They've gone nowhere but up since that time frame. There have been a few little dips here and there, but the overall trend for mortgage rates has been higher since the Fed cut rates. How is that possible? So the Fed is reducing their Fed funds rate, which is not a long-term rate. In fact, it's a one-day rate. Like the rate is only good for that day when the Feds cut it, right? Like it's the rate at which banks borrow money from the Fed. So, is there a correlation to mortgage rates? Absolutely. There absolutely is, but they are not the same thing. And so that's, again, the news is so bad at this. So just when you hear that the Fed is cutting rates, don't automatically assume that mortgage rates are also coming down with it. Eventually, I'm hoping mortgage rates will come down. But again, it's not because specifically the Fed is cutting rates. But when the Fed does cut rates, it almost immediately impacts things that involve lending, right? So things like money market accounts, credit cards, car loans, home equity loans. Because again, that's the rate at which banks borrow money from the Fed, and they are going to pass that cost on to you, right? They're not going to eat it, they pass it along. But it does affect change in those areas. Man, I almost want to read this just to get it out, and then I'm going to kind of paraphrase it. So long-term rates, like mortgage rates, are impacted more indirectly. An example of this happens as the Fed cuts rates and investors' returns on money market funds decrease. If it's anticipated that the Fed will continue to lower rates, which in turn will continue to reduce their return on money markets, investors may want to preserve their returns by selling their money markets and by buying longer duration bonds like 10-year treasuries. As more 10-year treasuries are purchased, their price tends to improve, which in turn lowers the yield. Mortgage rates typically follow the direction of the 10-year treasury.
Man, I don't know what the f you just said, little kid.
All right, so it's like this, right? So mortgage rates work a little bit differently because it's a 30-year debt and a 30-year rate, right? So when rates are on the higher end, not as many investors want them, right? But there's also something called the bond market. When you get a mortgage, let's say, I got a mortgage on this house, my buddy gets a mortgage, my other buddy gets a mortgage, my mom has a mortgage. All of those are clumped together after they're sold and done, and they're put into something called a bond. A bond is just a whole bunch of mortgage notes all put together, and then investors can buy them and sell them just like you buy and sell anything on the stock market. So mortgage rates tend to follow the 10-year treasury yield, right? So that's more of a long-term investment. The more people that invest in that, typically we see mortgage rates get worse, right? As more people are putting their money in those bonds or in those 10-year treasuries, that's when mortgage rates tend to get a little bit worse. But when they start selling those, that's when they start to get better. So that's kind of the closest way I can do it. But it's between the mortgage-backed security bond as well as the 10-year treasury yield. Depending on how those react and the investor sentiment that we get from those, that will ultimately determine where mortgage rates go. The other big killer of mortgage rates is inflation. Inflation is the number one killer of rates because inflation, too many dollars chasing not enough stuff, right? So it's devaluing things, and that's not good for a long-term rate. If the rate's going to be exactly the same on your 30-year mortgage today than it is going to be 30 years from now, that money, it's going to be worth less just from inflation alone. So this causes them to get worse and rates to get higher because investors need to make their money. With me so far? Probably not. Okay. That's just my biggest takeaway is when the feds cut their rate, don't automatically assume that means that mortgage rates are coming down. Again, in the long term, we're hoping that they will follow suit. There's a lot of other things that need to happen before mortgage rates come down. The Fed cutting rates hopefully will help that in the long term. But again, for now in the short term, it has not been helping. So I just wanted to get that out there so that you understood a little bit of how it works. Hopefully this was helpful for you. But if you do want to learn more about where mortgage rates are, what that does to your payment, all of that good stuff, anything regarding refinancing, home financing, I'd love to help. Give me a call. All my information is on my website. You can schedule an appointment with me, 10 to 15 minutes, even if it's just to ask some questions and you're not really sure where to go from there. I'd always be happy to help.
What the Fed cuts really mean for mortgage rates.
It's a good intro.